Welcome back to the Digital Asset Report. As we enter the first full trading week of 2026, we're seeing a profound decoupling between the old fiat world and the new digital economy. The urgency for this transition was put into sharp focus on January 3rd when the U.S. national debt eclipsed the $38.5 trillion mark. Adding $6 billion in debt every single day has forced a renewed discussion on fiat sustainability, and a conversation that coincided perfectly with Bitcoin's Genesis Day anniversary. This massive debt load is no longer just a domestic concern, it's driving a global hunt for hard asset hedges. We saw the direct result of this today as Bitcoin broke through its 50-day moving average to hit $94,000, finally giving speculators a trend they can trade on. This rally is being driven by more than just domestic debt fears. Geopolitical uncertainty is peaking following the arrest of Venezuelan President Nicolas Maduro and speculation over Venezuela's Bitcoin treasury.
So there is a second order crypto effect here where since for going back a decade now, my reporting was back in 2017, because of spiraling inflation of the Bolivar, a lot of people had turned to cryptocurrencies, mining Ethereum and Bitcoin in their homes in order to just have a stable source of cash. But the other side of this is the fact that there are multiple reports that the government itself has been looking to evade sanctions by doing sales of oil in Tether, which they then move into Bitcoin. And so much of this market moves on sentiment. So even the promise that perhaps the U.S. government, when they came in, might seize these assets, hold on to it, that's a bull case for Bitcoin if you have a stockpile such as that that isn't being liquidated.
All right, very interesting stuff. Very quickly, because we got to go. Is it a tailwind for just Bitcoin or also Ethereum, Solana, and some of these other coins?
It's a rising tide lifts all ships. In fact, XRP has had outsized performance. And when you see one altcoin do particularly well, it really is one of these signs of a risk-on environment.
This sovereign accumulation narrative is exactly what traditional finance is now racing to productize. The massive institutional demand for these hedges is evident in the data. U.S. spot crypto ETFs just surpassed $2 trillion in cumulative volume, doubling their size in just 8 months. This momentum is why Bitwise is now flooding the gates with 11 new strategy ETF filings for assets like Aave and BitTensor. They are essentially building the ramps for 71% of institutional managers who told Goldman Sachs this week that they plan to increase their crypto exposure in 2026. But the shift is going beyond just buying crypto. It's moving into how the system actually functions. This is where the 2026 regulatory calendar becomes the most important map in finance. White House advisor David Sachs has confirmed that January Senate hearings will finally attempt to end the SEC-CFTC turf war via the Clarity Act. And this legislative certainty is just the green light that firms like PwC have been waiting for. Today, they announced that they're leaning into stablecoins to overhaul global payment efficiency. And they aren't alone. Japan's finance minister Satsuki Katayama echoed this sentiment this morning, declaring 2026 the digital year and moving to integrate crypto trading directly into Japan's national stock exchanges. Even as the professional world formalizes, the crypto-native spirit is appearing in unexpected places. Trump Media and Technology Group is now moving to bridge the gap between equity and tokens by awarding shareholders digital assets through Crypto.com. This crossover between traditional stocks and on-chain rewards reflects a broader trend of capital migration. We see it in the CME Group's record $12 billion daily derivatives volume, and we see it in the December exchange data, where volumes on a centralized platform hit a 15-month low as users moved through decentralized venues and self-custody. However, this migration to self-custody brings its own set of challenges. As we build the rails for the new digital economy, the Wild West elements still remain. On-chain detective Zach XBT is currently tracking a sophisticated exploit draining hundreds of small wallets across EVM chains. It serves as a reminder that while the Genius Act and the Parity Act aim to bring safety and tax clarity by this summer, the technical risks of an on-chain future are still being mapped out in real time. $38 trillion in debt, $2 trillion in institutional inflows, and a global pivot toward national digital asset infrastructure. The transition from the old world to the new is in progress, regardless of the short-term market noise. That's it for today. If you enjoyed this episode, be sure to give us a like and follow along for more.